So in this video, we're going to talk about changes in the short and aggregate supply curve and how the economy returns back to equilibrium. So if you don't recall, the reasons that the short and aggregate supply curve could change, or the factors that shift the short and aggregate supply curve, are as follows. So pick any one of these and let's talk about a decrease in the short and aggregate supply curve. What happens to the economy when there's a decrease in the short and aggregate supply curve? We're going to start, as always, at our equilibrium model. Price on the y-axis, real GDP on the x-axis. At this point, you've heard it over and over. The next line to this is long-run aggregate supply curve is vertical, short-run aggregate supply curve is upward sloping. Aggregate demand is downward sloping. The equilibrium price we're going to denote as P star. The equilibrium output Y star. Equilibrium output is where the natural rate of unemployment is equal, or where the unemployment rate is equal to the natural rate of unemployment. This economy is at equilibrium. It is satisfied. It's not going to change unless there's an outside force. So we're looking at a decrease in the short and aggregate supply curve. Let's say that there is a negative supply shock, something that causes supply to drop drastically. This will cause the short and aggregate supply curve to go to SRAS 1, and we go from point A to point B. What's happening at point B? The price level in the economy increases to P1, and our output falls to Y1. So we're in a recession with inflation, also known as stagflation. If you've heard that term before, that's what it's referring to. A situation where we're going into a recession with increasing price levels. The economy is in a recession. That means U1 is greater than U star. We have more unemployment in the economy than optimal. How is the economy going to return to equilibrium? It's always the same story in the the ASAD model. Without any government intervention, the response or the correcting factor is going to be a change in the wages. Whenever we have a recession, people accept lower wages. So as they accept lower wages, this shifts our short and aggregate supply curve back to the right. So we go from point B back to point A. And the economy is exactly where it started off. The difference is wages in the economy have fallen. And that's how the economy returns back to equilibrium with the optimal level of employment. Now let's take another look at the opposite situation. Here we're going to start off an economy that's at equilibrium. Right, so we started off at point A, and what happened in this economy is there's an increase in the short and aggregate supply curve. So one of the shift factors caused our cost of production, for instance, to fall. So our short and aggregate supply curve now shifts to the right, SRAS1, and now we're at point B. At point B in the short run, we know this is a short run situation because we're not at our long run output. The price level falls to P1. The economy is producing Y1, which is higher than our capacity output. That means we're in expansion. Firm is experiencing profits. What ends up happening? You as an employee start to ask for some of those profits in the form of higher wages. This increases the cost of production for the firm, so we go from point B back to point A. And that's how the economy gets back to equilibrium. In all of these examples, the factor that stabilizes the economy is changing wages. And that's why it's important to have an economy that has flexible wages. The more rigid wages are, the longer our expansions are, and the longer our recessions, the more volatility in the economy, because we're not able to adjust. Prices are not able to get us back to equilibrium. So when you're looking around the world, whenever you're looking at wage policies, in economies where wages are more rigid, you're going to have more volatile business cycles. More flexible wages will allow the economy to return to equilibrium as fast as possible. The issue here is you're relying on people to accept lower wages in recessions, or to start to ask for higher wages during expansions. We don't know how long it takes people to make that adjustment. It might be a month, might be 12 months, might be 2 years. It has a lot to do with social construct as well. What does society say about asking for wages? There are gender differences with negotiation for wages as well. So we have to think about the overall society and its impact on how we navigate through this economy. In the next video, what we're going to do is look at changes in the long run aggregate supply and how the economy returns to equilibrium.